Despite raw material challenges, MINDA Corp sustained healthy performance in Q1 FY23. The company reported sequential growth in revenue, driven by higher share of commercial vehicle segment, and its operating margin meanwhile declined marginally owing to rising costs. A recovery in demand post-COVID-19 for passenger vehicles and two-wheelers, increase in content per vehicle and growth from new focus areas make us upbeat about the company. The company's strong order book and robust product portfolio add to our confidence. And at the current valuation of 18.1 times FY24 projected earnings, the stock looks extremely attractive. On the back of rising contribution from the CV segment, which stood at 30.1% in Q1 FY23 compared to 18.5% in Q4 FY22, the company reported a quarter-on-quarter growth of 6.6% in net revenue. Revenues from mechatronics and aftermarket also grew 5% on a QOQ basis. The growth was led by increase in market share, resilient demand from aftermarket, and increase in exports. It's interesting to note that despite a significant rise in raw material prices, EBITDA margins came in at 10.6% in the quarter gone by. Margins could be maintained above 10% levels thanks to operating leverage and prudent cost management. MINDA Corp generated around 58% of its revenue from two-wheeler and passenger car segments in Q1 FY23. With easing semiconductor shortage, these segments are expected to witness significant surge in demand. Furthermore, with pent-up demand and rising traction post-reopening of colleges, schools and offices post-pandemic, these segments look set for good days ahead. Management is quite upbeat about these segments and has indicated that preference for personal transport will continue to be a key growth driver. With broader economy opening up, the CV segment is also picking up fast. Thanks to increasing construction and mining activities post-COVID-19, demand is expected to rebound sharply. What makes MINDA Corp different from other auto component manufacturers is the unending desire to innovate and come out with new products. The company has been working on new areas that are expected to grow significantly in the years to come. MINDA is currently focusing on keyless entry solutions, for which it is in talks with multiple OEMs. Now, these solutions are expected to have 3 to 4x content per vehicle compared to traditional method. In the emission system, it's working on wiring harnesses, compressor housing and powertrain sensors. It's focusing aggressively on EVs as well. The company is developing products related to battery chargers, DC-DC converters, BMS modules, motor controllers, sensors, telematics, etc. In fact, the company has already won orders in this space. What's encouraging is that MINDA Corp continues to get new orders which translate into earnings visibility. In Q1, it received orders with an overall lifetime value of more than 2,500 crores. Of these, 20% of orders were for the EV segment. Management hopes to generate 80 crores from EVs in FY23, up from 20-25 crore range in FY22. Now, of course, like any other company, there will be some downside risks to watch. Any slowdown in demand could hurt the company's financials, and any adverse movement in commodity prices would raise raw material costs and hurt operating profitability. But if we look at the stock valuations, it's trading at an attractive valuation of 8.1 times FY24 projected earnings, like I flagged off, and therefore we advise investors to buy the stock with a long-term perspective.